Hello and welcome to Wealthy and Wise. I'm Nadine Blayney. It's great to be here with you today as usual. Well, small caps can offer some of the market's biggest opportunities, but they also come with greater risk. So how do value investors separate tomorrow's compounders from tomorrow's disappointments? This week on Wealthy and Wise, we're looking at small caps through a value investing lens and asking what really matters when assessing businesses at the smaller end of the market. We'll add some value with Nick Cummings from InvestSmart, and then we'll go head-to-head 5 stocks, all small caps, to see if they pass the muster when it comes to the principles of value investing. First, let's add some value. All right, investing in small caps isn't about chasing the next big thing necessarily. Can it be also about finding quality businesses before everyone else does? So let's explore what value investors look for in a small cap, from predictable earnings and strong management and the like. Welcome to the program, Sanjeev Narendran from Teaminvest and Nick Cummings, who's joining us from InvestSmart. Great to have you both here. So is it a misnomer, Sanjeev, just to start, to say that value investors would not be interested in a small cap?
Oh, no, absolutely not. There's a lot of great opportunities in the small cap space. And, you know, to me, it's not the size of the business that matters, but I do like to see the history and what the business does. So there's great opportunities in the small cap space because they've got a long term to continue compounding and grow into these large businesses.
So small caps through a value investing lens, do you look at them or consider them any differently than you would a large cap?
In some ways, yes. I think for us, management teams in the small cap space are hugely important, particularly compared to the large caps. And that's mainly because 1 or 2 major decisions can make or break a business, whereas that doesn't tend to happen as much in large caps. So we're looking for management teams that have been there and done that, founders aligned with shareholders. We like to look at their incentive packages to see if they're using, dubious metrics like EBITDA or earnings, rather than, more concrete measures like return on capital or earnings per share. So management's a huge part of it. The other big one we look for is in their presentations. And this is one we don't look at as much with large caps, but because small caps need to promote themselves regularly in some cases to raise capital if they need it, you can tend to find presentations that are overly promotive, very positive, and they tend to not really focus on the substance. And so you can, just wipe out a ton of those by just looking at the presentation. So we try to avoid in the small cap space those that are diluting their shareholders and those that really, can't illustrate a concrete picture of what they're trying to do in their own annual reports and in their own reports instead of relying on presentations.
Yeah, I've seen a few what you can only call chart crimes in some small cap presentations. But just to push your point a bit, because you did talk about some of those financial metrics and the manner in which they report, but you're not saying that every small cap that you would consider needs to be profitable? Or does it? I don't know.
No, but we want to see at least a very clear path to profitability. Too much of the time, companies are unprofitable and they say, oh, yeah, once we reach this scale, we will be profitable. And then the scale comes and they're still not profitable. So we prefer companies that are profitable, for sure. It's not that we won't invest in an unprofitable company. We just want to see, a very clear path to how they get to profitability.
Sanjee, we've talked many times in the past through this program about stability and some of those key metrics that you all look for, including profitability. Not all small caps are profitable, but they do talk about free cash flow and they talk about cash generation and the like. Is that all just gibberish to you?
No. I mean, it's all valuable, but the benefit of us as investors is we get to pick and choose what we want to invest in. So whether it's a small cap or large cap or whatever, I mean, I look for businesses that are profitable. And those ones that are new and more haven't proven themselves yet, I'm happy to sit them out. They can make great money. Their share prices can go through the roof it's okay. I often say when people ask me, oh, yeah, you missed out on this company and that company. It's like, yeah, but I also didn't win the lotto last week, right? So I'm okay with not making the money, and that I'll leave that to somebody else that is better off, in those speculative, win some, lose some, high gain positions. Whereas I know that I can find a business, and there's a lot in the small cap space that do make regular profits. They do grow their profits. They have stable returns, and the one of the biggest contributors to compounding is time. These businesses just need more time to continue compounding, and the longer you leave it, the bigger and bigger it starts to compound. And they've got the runway, they've got the ability to do that. It's just a hard job to try and find which ones and pick them out of a large number of small caps.
So to Nick's point, though, is management in small caps, I mean, I know you guys always look at alignment and everything else, but is management and the ability to execute even more important when it comes to some of these smaller companies?
Yeah, I'd say they're both very important, whether it's smaller or larger, but in different ways. And as Nick said, in a small cap, you've got a management team that needs to be able to really understand what they're doing. They don't have a lot of resources around them that they can access to deal with problems. They're still building those up, but they can do that smartly, and that's positive sign of good management. In the large cap spaces, things can get quite corporate or quite large, and then you get a lot of the professional board directors and things like that, which I'm not a huge fan of, but people coming in, and you've then got to answer to proxy advisors, answer to the super funds, answer to the retail holders, the government, and they start to make bad business decisions. So it can be damaging. Bad management is damaging whether you're in a large cap or a small cap. But yeah, in a small cap, you need to have a really close eye on the management, because they're very integral to that business.
Yeah. So I'm just love this conversation, because I actually have a soft spot for small caps. Do you only, Nick, invest in small caps that you think would have the potential to become the next CSL, or is that not sort of a filter that you would apply?
I actually think that's the worst way you can invest in small caps. Like Sanjee said, only a few companies each year win the lotto. So we're not focused on those. If we miss the next Afterpay, so be it. What we're focused on is actually those more boring, mundane businesses that compound earnings year in, year out, led by strong, capable managers, excellent, free cash flow metrics, clean balance sheets. Again, not promotional is a big one. And then avoid dilution. And if you tick a lot of those boxes, you tend to find great businesses. But it's like Sanjee said, you just got to let time take its course. And
so you've talked about dilution a couple of times. So you're talking about capital raising, yes, or share purchase plans and the like. So or you can correct me on that. So yeah, like a small company can never raise capital? No,
they can. They just need to be clear for why they're doing it. So we don't want to see a company doing it for working capital purposes. We don't want to see a company doing it to make a large overseas acquisition, or an acquisition that isn't in their circle of competence. And you do see that in some small caps. So yes, they can raise capital by all means, but we just really want to make sure they're raising capital for the right reasons rather than some of the other reasons.
What do you think about dilution?
Yeah, coming from the broking background and the broking world, every time they raise capital, and it's great for brokers, you get quite a bit out of it, but it does impact you as a shareholder. You do get diluted. And over time, the more and more it happens, you get more and more impacted. So at one point you had a certain percentage of the company, 5 years later, it would be a fraction of that that you hold. So when they do actually start making profits, your slice of those profits are nowhere near what you thought when you bought in. So there's a lot of that goes into the cap raising side. The other side of it, I look at as knowing from the broking perspective that there's a lot of hype and a lot of market you need to to get people excited about the industry, you need to get people excited about the company, you need to promote a really, really great story. So then when you do a really good job at it, the PEs go through the roof. So then that you can raise capital at higher and higher prices, but the business doesn't justify those valuations. It's the story that's taken a life of its own. So then you start to get really high PEs on companies, and they tend to be the companies that are raising money, doing all these kind of things. Whereas the boring businesses that don't need to raise money, they're using their profits to reinvest and continue their growth, they don't get the high PEs, but that's okay, because that's where I find the values.
So valuation still does matter at the smaller end of the market as well. What about dividends? Do you consider dividends as part of the story when you're thinking and considering small caps?
It's not a thing we have to see, but it is typically a good sign. It shows that management are thinking about capital allocation, that potentially they don't need that extra capital. A lot of small companies won't pay dividends because in case of a rainy day, they've got some spare cash in the bank. So it's a good sign that if they are paying dividends, they say, oh, management's pretty comfortable with where the business is at, and the economic mode is intact. So it's a good sign, but not something that we have to see.
Is that true for you?
Yeah, I mean, it's good because that means they're making the profits to pay out the dividends. But it's, I don't mind whether they're reinvesting the dividends as long as the business keeps growing. If their profits and the earnings keep growing, earnings per share keeps growing, then you're seeing that money, because their earnings are our shareholders' profits. That is what we've invested in for. So whether they're going to continue to take advantage of those earnings and hold it in, I don't mind. But I know there are some investors that require dividends and they require the income from that. So it's just about balancing and finding which portfolio allows you to extract the largest dividends. But the growth is the important story.
Okay, final question before we put some of these companies head to head that have been nominated. And it's quite a motley crew, I've got to say, about small caps. To that point, are there sectors that you are more inclined to consider investing in small caps? And I'm just thinking, oftentimes we think of small cap growth companies or small cap tech companies. We've got a lot of AI enthusiasm right now in the market. Is there anything that you would sort of steer clear of generally in small cap land, or does it all come down to the numbers?
Look, ultimately it does come down to the numbers, but a good rule of thumb is to just avoid whatever's in the financial press at the time. At the moment, there's a lot about AI, a lot about defense, a lot about resource stocks, explorers. So, we haven't found any opportunities really then. We've avoided them, but we wouldn't rule out any specific sectors except for probably one, and that is the small cap lending space. And we'll go into that a bit later, but I think that's a very actually structurally competitive market, and most small cap lenders end up in disaster.
Really interesting. Okay. May I ask you about biotechs then? Because a lot of small cap companies are biotechs by their very nature. They need to raise capital at certain milestones to fuel their future. Would you just rule them out?
Yeah, I mean, it's one of those that I can sit and avoid, right? I don't have to be invested in it. And I wish biotechs all the best, because it just means better health systems and better opportunities for us as consumers potentially. But it's from an investment case, I don't need to invest in it unless it's got a proven track record. So why am I taking that gamble? Because every biotech thinks they've got the cure, they've got the answer, they're going to be, and not all of them are going to win. They're not all right, and the vast majority are actually wrong. So, unless you're really close to that space and you have a very deep circle of competence in that industry and understand it to know why one solution is better than another solution, then it's a hard thing for me to invest in. I'd rather sit it out, let them, work it amongst themselves, come back. And at the end of the day, my goal is to compound my portfolio. I mean, I'm aiming between 15 to 20% annual compound rate,
Okay.
So if I can keep doing that without taking the risk of some of these speculative ones that maybe might do, And if I don't need to, then why?
Well, I can tell you Sanjee is a happy man, so he's obviously something's working. All right, let's leave that conversation there. I'm sure we'll touch on some of those themes again. Let's go head to head. Theory is one thing, finding opportunities is another. So in this segment, we'll put 5 small caps under the microscope, applying the same value investing framework to see which businesses stack up, where the risks lie, and which companies might even be worth a closer look. So still have Nick Cummings here from InvestSmart and Sanjeev Narendran from Teaminvest. Let's get to stock number 1. Let me just check my list here. And I think first up, what we've got is it Judo Bank? Judo Bank came out with a shocker of an update. Saw its share price tumble 40%. Is this one that you would buy?
No.
No value in it.
Look, there might be. I just think the downside in this space is too big that we can just sit this one out. Look, small cap lenders, these are tough businesses. And I get why investors fall for the trap here. Earnings typically grow very fast because the loan book is growing very fast too. But that fast growth of the loan book a lot of the time obscures the bad debts that are building in the business, and then it all comes home to roost pretty quickly. And you've seen that with other small cap lenders, Silver Chef, Access Today, Pioneer Credit, Money3. I mean, it's a long list of blow-ups. I'm not saying Judo will go that way, but it's too big a risk to take. Essentially, each one of these businesses is competing against the banks head on, and they have a cost of capital disadvantage, or they're competing in a space the banks have said, that's too hard, it's too unprofitable, we don't want to borrow of them. And this doesn't stack up for us.
All right, so that's Judo Bank. I don't know, does Judo Bank have 10 years of history behind it?
No, they don't. It's probably around 4 or 5 years, so it's not quite enough for us to really look at a Teaminvest. But I mean, for all the reasons Nick was saying, it's hard to be in that space. The other thing is, the large banks, they've got so much data and there's so much access to information that they're able to price risk more appropriately. Whereas banks like Judo don't have as much data points to assess and value the risks in the same way. So that's a big challenge for smaller banks here. The good thing is they're at least a profitable business. So compared to many other businesses out there in the market, you're at least got something that they're falling back on. And currently they're trading pretty low at a low valuation. But I would rather see something that I could reliably say that this is going to be materially higher in 5 or 10 years time, than worry about, is my money going to be safe here? Considering the current economics climate, there's a lot of uncertainty going around. Things can turn bad very quickly. And, even the larger banks have been saying, we're getting ready to prepare for defaults. So they're all bracing themselves. They're giving themselves buffers to deal with these defaults. When you're smaller like Judo, it's a much harder challenge.
Well, and I mean, we saw that with their 3 customers that apparently they sort of did not see coming, and snuck up on them very quickly, and the shareholders as well. So the next one on the list, and I think this is an interesting one, dovetailing from Judo Bank, is Cuscal. So this company provides sort of systems, payments, data to Australian banks, mutuals, and the like. So is this a better way to get into that financial services thematic?
Yeah, we think so. So Cuscal is essentially a payments infrastructure company. It focuses on the credit unions and the non-bank big 4. So they're pretty much the 5th payment processor or back-end payment processor in Australia. It was actually set up by the small banks about half a century ago. So even though it's only been listed 18 months, there is a long history here. We think it's a pretty good business. Every time one of those credit union customers tap their card, Cuscal gets a nice fixed fee, and transaction growth over time sort of follows GDP, but it's actually going a bit quicker than that now because we're actually splitting payments into more payments. So an example might be Netflix. So instead of paying annually, we pay it in monthly subscriptions. That takes, one pay or turns one payment into 12.
Yeah.
Cuscal really benefits from that. If you look at the return on capital and the return on equity, it screens quite poorly, but that's just a function of them having to hold a lot of regulatory capital. So if you adjust for that, the metrics are quite good here. They've made two big acquisitions recently. One is their sort of New Zealand peer, and the other one was their main competitor in Australia, Inju. And so the peer at the moment is about 20, but that's deceptively high because they've got a lot of integration costs at the moment. There's a lot of duplicative costs that they will be able to take out over the next 2 to 3 years. And so that PE or those earnings should really start to grow over the next couple of years. So it's one we like. We've probably got to hold on it now for valuation, but
You knew what I was going to ask you because the share price is up, 8% year to date. Totally has flown under my radar, at least. Now, I know that it doesn't have the history as a listed company that you guys like at Teaminvest, but any comments? Because we haven't talked about this one a lot.
Yeah, I mean, it's one of those businesses, and that, like, if you're going to go in and start doing the research and going back and looking at the history, you might get a better picture of it. I mean, I'm sitting here a little spoiled for choice, and I'm also looking at some really good companies that is just too much work for me, right? So I'm a bit lazy like that, and I'd say I don't bother. It's only 1 year listed history. They have made that Paymark acquisition. They've got a lot of scope for growth, and for all the reasons that Nathan was saying, Nick was saying,
Yeah.
There's a lot of opportunities for them to continue growing, and it makes sense. I would like to see it once they've done it. So once they've gone there, made it stable, continued to grow that and achieve that, then for me, it's a business worth investing into. I would have seen management in action, delivering on what they said they were going to deliver, and how they've achieved what they're doing. Great. So I'm happy to sit out and watch, but it's not really something that, it's too early for me to get involved.
But I do think it's interesting because you don't mind that they acquired that company in New Zealand, presumably because it's in their wheelhouse.
Absolutely.
Yeah.
Completely in their circle of competence.
All right.
No, I agree. I think it seems to be like a good acquisition from looking on the outside without having to do much work on it.
Yeah.
If I'm, in my lazy way of investing, I'd rather see them do it on market and see those announcements, see the history. I don't have to go then and look back at what they haven't published, or hasn't come through the ASX. But if you're looking at these kind of things, you need to spend a lot of time doing research.
Well, honest answers only, as I always tell you, Sanjee, and this is head-to-head, so I'm quite pleased if we don't agree on everything. I wonder if we will agree on the next stock on the list, and that is Guzman Gomez, GYG. Boy, was there ever a more hyped IPO. Hard to think of one. Do you buy it? Not as an investor, as a consumer. Is that enough to sort of sway you as an investor?
Yeah, well, I love it as a consumer. It's a bit of a battleground stock at the moment, so there's some really big backers in this, but at the same time, I think 10% of stock is shorted currently. I mean, there's a lot to like. The store economics here are excellent for a fast food concept. There's a huge store rollout opportunity. Got about 250 stores in Australia. Management wants to take that to 1,000, which would rival McDonald's size currently. Easier said than done, but that's the goal. And then the actual customer base skews to younger customers. So I think it's like 85% of their sales are from people under 44. So these are all good signs. It's chaired by Guy Russo, who was the ex-McDonald's CEO of Australia when they rolled out. So yeah, lots of stuff to like. I guess the bear case might be that as these stores roll out, do we see them cannibalize the sales of his existing stores? And can those store economics hold up? And we really don't know. And we're paying sort of 40 to 50 times earnings for it. And so we just think it's too hard basket at the moment. It's not to say we wouldn't ever like to get involved with Guzman Gomez, but for now, it's just a bit too hard.
you're old school, calling it fast food. They're QSRs, don't you know?
Fast casual, I think.
Yeah.
You got that for it.
But they did pull out of the US. They're really committed to that strategy, but they have sort of had the sense, I suppose, not editorializing too much, to realize that that's a pretty tough market to break into. GYG, I know that it's a new listing as well, but the valuation alone would make you not take a look.
No, we would never look at it for for a lot of reasons. The history is one of them, or the lack of history is one of them. The movement into the US, I don't know what was going on there, thinking there's a huge Mexican population in the US. There's Taco Bell, there's a whole lot of other companies out there. Yeah. What made Guzman and Gomez, they have very grand ambitions, think that they can go out there and do better in the US than the locals, right? So I thought, that was a silly thing. It was very hyped up to, for the IPO, for the capital raise. They're carrying a lot of debt, and I'd watch that debt increase as well, I'm sure, as they get more and more sites out there. I just can't see the moat around this business. What does Guzman and Gomez have? And it's probably true for a lot of, similar fast food businesses or whatever you want to call them now, but they're, what is that moat that says, okay, people are coming here? McDonald's has built that over decades, and they built that brand name, McDonald's, KFC, and the big main ones there. But outside of that, how do you compete? How do you build a moat that allows you to charge a premium, get your market share, and grow this kind of business? I don't see it. So for me, the risk far outweigh the moats. So I don't think this is something that, I'd ever want to be invested in.
There you go. That's a hard no for GYG from both of my guests. I like this game. Let's go head to head with a company called Hansen Technologies. Is it wrong for me to say this is probably one of, the least sexy tech companies out there? I mean, it's not really talking up AI. It's not really putting out any flashy sort of presentations, is it?
Yeah, it's no, it's quite boring and mundane, and that's the reason we like it. So it provides billing software for utilities and telco customers. It essentially tells them what a customer owes and how they're going to invoice it, collect it, and report it. This is pretty mission critical. And look, I use those words sparingly because everything, every tech company says what they do is mission critical, and a lot of it actually isn't mission critical. But no, this software provides real value because it essentially helps the telcos get paid, and that's what they needs to happen. So we like it from that perspective, and we think it's insulated from the AI risks from that perspective, because it's sort of a low cost and pretty high importance to its customers. So we don't think someone's going to vibe code it, and it's not something their customers actually want to fiddle with or replace too often. Their churn rates are incredibly low. You can buy it today at around 13 times next year's earnings, which seems like a great deal for us. You do have to be a little bit careful. As you said, it's pretty boring. It grows pretty slowly, sort of like GDP-like growth, but they juice that up by making acquisitions. So you have to be careful with that. And then the other thing, just to take note of over the last 6 months, is the Australian dollar's gone up, and they make a lot of sales in Europe. So that might be a headwind for this half or for the full year report. But if you can look past that, we think, it's a pretty good opportunity.
Yeah, because it has not performed over the past year. It's down by close to 30%. So there's the value in there. But what happened? Is it because they've got caught up in the whole SaaS apocalypse?
Yeah, that's what we think. We think the report or the financials have been excellent, in line with what we were thinking. But like a lot of these companies, they've just sort of drifted lower despite the fundamentals not changing too much. And it's really been a price to earnings re-rate, and you buy it at one of its lowest in a fair few years. So
I'd say that's a buy. Would you buy Hansen Technologies?
Look, it's actually at an attractive price at the moment. I would like to see my investments go into businesses with a bit more growth than Hansen has had. I'd like to bring up Hansen on Conscious Investor and actually show what that might look like. If we're looking at this in terms of the return on equity and return on capital, it's reasonable, and you can kind of see that there. Ideally, we'd want to see around 10% at least. It chops up and down a little bit, but it hovers around that range of around 10%. In terms of its growth, it's one that has had some growth. It is kind of growing its earnings a little bit. Overall from 10 years, it's doing much better where it should be, but it doesn't have as much stability as I would normally like in a business like this. So but they've also paid off a lot of their debt. So the debt's really come down quite a bit as well. Not that they have much debt to really begin with. But as Nick said, the price, it was, I think, a little bit overvalued before. It's now come down to around a P of around 13, which is fairly cheap, I think. So if it is interesting to you, then it's more of a reasonable price right now. Personally, I'd like to see my money go into a business that has a little bit more growth than that, what I'd expect out of this at 5 to 6%.
All right. So Sanjee, I'm going to go to you first on this one. We've got another company here to cover, and that is XRF Scientific. XRF is the ticker code. It was just covered on the call, I think, last week. I'm pretty sure it got a double buy. Does it pass the Teaminvest filters? It does.
It does pass all of our filters. I'll bring XRF again on Conscious Investor. And we can see there it's got a full suite of greens. It is looking very attractive at the moment. And if we look at why that's the case, it's a business that has return on equity, return on capital consistently above 16, 17%. It's doing pretty well.
Even I can see that that's all going in the right direction.
I mean, and that's just the return on capital side. If we look at the growth looks really, really good. So it is a business, X-ray fluorescence spectrometry. I got that out without stumbling. That was good. But they manufacture the machines, do the testing for all these miners and things like that. They've pioneered, or they've really made good use out of the engineering the side of things. They use the platinum crucibles. They recycle that, so they sell plate platinum again, recycled ones, and so they've done really well. They've made a recent acquisition, which is a very small acquisition, about $5 million worth, on a I think it's a business that comes in 3 parts. But again, it's complementary to what they do. So it's a good type of business that can keep growing. They know what their mode is. They know they're in the engineering space. They know that they've got the client base for, people like BHP, Rio, South 32, Glencore, the whole lot. And it's just about getting those samples, identifying the quality of those samples. That is something very important. They've got a reputation in the industry for doing that. So now they can add in those acquisitions that look at, I think, what was it? Elemental analysis of carbon, sulfur, oxygen, hydrogen, nitrogen, all that kind of stuff.
But away from that, its share price is down by 20% this year. So therein lies the value?
Yeah.
Okay.
I mean, why would the share price fall? I mean, it's the market sentiments move up and down. The price is down at the moment. Has anything in the business changed? Yes, they've done an acquisition. There is a bit of an acquisition integration that they've got to do. It's not new to them. They have done small little acquisitions in the past, and it's not a significant acquisition that could be a much higher risk to this business. It is just a business that continues to produce, to grow. Once they get these bolt-ons in, they can continue growing those earnings. So I expect that this is a business that could be materially larger in 5 years' time.
Okay.
That makes it a good opportunity for me.
Agree?
Agree.
Okay.
Yeah, full disclosure, I own this one personally.
Yeah.
Like Sanjee said, it's a brilliant business, got a razor blade model, and pretty much the exact example of what we were speaking about at the start of the show of there is value you can find in small cap. It's only a $250 million business, but what was it? 8 years ago, it was a $25 million business. So management's done an exceptional job. I'm going to go out on a limb here and to say I think it's the best management team below a $500 million market cap on ASX. They make small, smart acquisitions. Heads we win, tails we don't lose much. The margins are great, conservatively run, balance sheets excellent. Yeah,
No complaints.
Can't fault it. Ticks all the boxes. And then if you look at its sort of potential earnings coming up in the next year, I think they could benefit a lot from this exploration spending and more samples. So they're in a good spot, I think.
Well, let's stop there, end on a high, because that's great. That was XRF Scientific, and the ticker code is XRF. Look, we have run out of time for a viewer question this week, but I promise we will get to one next week. You can email wealthy@ausbiz.com.au if you have a question for the team. A huge thanks to Nick Cummings from InvestSmart for coming in. Appreciate that. And Sanjeev Narendran from Teaminvest as per usual. Told you I have a soft spot for small caps. Thanks for watching Wealthy and Wise. We look forward to seeing you next week.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.